Crummey trust is an irrevocable trust. So you set the terms, and those are the terms. And they're specifically geared to qualify for the annual gift tax exclusion. And so some trusts don't qualify for it because they don't have the right terms. But they're set up so they qualify for the annual gift tax exclusion. And you can make, typically they're for a single beneficiary. And so if you had 3 kids and you wanted to set up, you wanted to make Crummey gifts to each of them, you would set up three different trusts, and you would set up recurring payments each year, and you would make $18,000 gifts to the trusts each year.
So maybe do you want to explain kind of why someone would, like, what are the key benefits as to, okay, so you're gifting that annual exclusion. So let's take the scenario, there's 3 kids, 6 grandkids. Let's just focus on, hey, you set up 3 Crummey trusts just for your kids to keep it simple. And it sounds like each parent would give $18,000 to each trust.
Yeah.
So each parent they'd be giving $36,000 to each kid each year. Yeah. So it's $108,000, and that's just the kids, right?
Yeah. So there's a few different tax benefits that a Crummey trust provides. So the most obvious one is that you're getting that $108,000 in this example a year out of your estate for estate tax purposes. But there's two other really big benefits, tax benefits. So one of them is all the appreciation on the money inside the trust is also outside of your estate. So you gift $108,000 a year. Those you invested in the stock market or index funds, whatever. Eventually, the appreciation is going to dwarf the amount of principal that you actually contributed, and so that's a big benefit. And then the third big benefit is that so these trusts are usually set up as what's called grantor trusts, which means that the donor typically pays the income tax that the trust earns. And so, in other words, you're paying the trust's income taxes for it. Over time, as you contribute more and more to the trust, and as the trust generates more and more returns, eventually the trust gets pretty big, and its annual income tax liability becomes pretty substantial. And so, ultimately, that's actually the biggest benefit, is being able to pay the trust taxes. If you give $36,000 a year to a trust, for 30 years, but by year 30, there's going to be a huge amount of money in the trust.
And let's just make this practical, right? Like, let's take the scenario where between the 3 kids, hey, each year they're giving $36,000 plus inflation to each kid's trust. That money's growing, compounding. Let's say those 3 trusts are worth $1 million, and it generates $100,000 of income, right? So first of all, that $100,000 of income, let's just say it's taxed at 35%. So that's $35,000 of tax liability there. Now, typically that $35,000 would reduce the value of those trusts. Those trusts would have to pay the taxes, and so they lose $35,000. Now, what happens with these Crummey trusts is actually the parents, they can pay that $35,000. So first of all, they can gift between the 2 parents $36,000 to each kid's trust every year. And then they can pay the taxes on the income that trust generates. And to kind of what Peter's saying, this is really powerful because there's twofold benefits. One is, instead of that trust losing that money, the trust gets to keep what would otherwise be lost to taxes, gets to reinvest it, and that money keeps growing. So instead of losing that $35K, it gets to reinvest it, and that $35,000 will create more wealth. And if you know anything about compounding, over a long time period, it becomes really significant. Every year, you keep your taxes and get to reinvest it. I'm sure everyone here would love to not pay taxes, and you'd be a lot wealthier. Well, that's what a Crummey trust allows these kind of kids to do. And then the other part about it is, let's say that the parents are, take that scenario, they're worth $60 million. They're significantly over that gift exemption. So one, they have their lifetime gift exemption. They're likely going to deplete that. Then they're going to keep on gifting each kid, each grandkid, their annual exclusion. And then it's almost like another annual exclusion of they can pay the taxes off. And that doesn't count as a gift, doesn't count as a gift, or doesn't use up their lifetime gift exemption and doesn't create a tax. So it's almost like a bonus gift that they can make to their kids.
Yeah.
Is that right, or am I missing anything there?
Yeah, that's exactly right.
Now, let's say it's like, what are the common use cases when people use Crummey Trust?
Yeah. So it really makes sense for anyone who has any sort of estate tax issue or exposure. I think a lot of times. So first of all, in my experience, most people who have estate tax exposure don't make annual annual exclusion gifts at all, which is a huge mistake. Those who do typically make outright gifts, which have a few drawbacks, which I can kind of go into. But and if they don't make outright gifts, they're usually making gifts to custodial accounts for minors, like a NUTMA account, for example. And so, sort of briefly, that the reason, there's a few reasons, but the big reason is you want to give to a Crummey trust instead of giving to someone outright. So first, there's the tax benefits. So if you give someone $18,000 a year, you're getting that $18,000 out of your estate, but you're not paying the taxes on $18,000, right? You can't pay your kids. You can't pay your kids' income taxes normally, but if you set up a Crummey trust, you actually can. You can pay the trust taxes. So there's
just to kind of hit that home, that 18,000 you give, it's the income taxes on that 18,000 this year. It's the income taxes on that 18,000 and its growth next year. It's essentially the lifetime. You have to think about it as to like really understand the impact of. It's at 18,000, and let's say it's you and a spouse. It's $36,000. That the taxes on that this year, plus every single year moving forward.
Yeah.
And the growth on that, and that's where it really becomes substantial, and the compounding really makes it meaningful.
So if you give, to make it more concrete, if you give $36,000 a year adjusted for inflation to a Crummey trust, and you start it when your kid's a baby, by the time the kid's 50, assuming let's say 9% returns, there's going to be $35 to $40 million, depending on assumptions, inside of the trust. So it's just a huge number. And if you'd given the money to the kid outright, you'd have nowhere near that amount in the trust because the kid would have been paying their own, or the kid wouldn't have nearly that much money because they'd be paying their own income taxes.
Yeah. And
so it's more tax efficient, but the other thing is, the trust gets creditor protection. So, if you give money to your kid, and your kid gets sued because they get in a car crash, or they get divorced, and the divorcing spouse is trying to claim some of their assets, that's if you use a Crummey trust, those assets aren't subject to creditors, and including divorcing spouse. Whereas if you give the money directly to your kid, there's a real chance that some sort of creditor can go after those assets, and so it's more creditor protected. You also retain some level of control over the assets. So, obviously, if you give your 20-year-old $36,000, they can spend it however they like. If you put it in a trust, and you have a trustee who's not your 20-year-old kid, they can't go out and spend the money on some party or vacation or whatever, and so that's sort of a guardrail. And then compared to custodial accounts like UTMA account, you can keep the money in trust for the rest of the kid's life. So with UTMA account, for those who aren't familiar, they're accounts that people set up for children, but they have to terminate when the child becomes an adult. So it's usually either 18 or 21, depending on state law. But a lot of people give $18,000 a year to an UTMA custodial account, and then the kid turns 21, and there's $1 million, whatever, in that account. and the kid gets that $1 million, which they can spend personally.
Yeah, this is, I'm sure speaking for kind of a lot of folks is, personally, I don't know if it would have been a good idea to give me $1 million at 21. And I'm sure that's, as parents think a lot of times with their kids, right? Like they want to give that money to them, but 21 may not be the right age to give that to them. And so this is a control feature. Now, all these things, and there's some great questions in the comments that we'll get to. So this is where, it kind of sounds like, so one use case, if you're over the lifetime gift exemption, this is kind of a really obvious way to pass on assets. There's also potentially kind of another, let me know, Peter, of like, let's say, you're close to the lifetime gift exemption and you want to start, depending you expect to be over it in the future. This is another way to give small amounts every year, not move a ton of assets outside of your estate, but also give you flexibility of preserving your lifetime gift exemption, but also starting to kind of incrementally move assets out. Is that fair?
Yeah.
Now, it'll just kind of, all these things, it's kind of a very powerful package. You call out, people don't use this often enough. One of the key things to call out here is, historically, you're gifting $18,000 per parent per year, per kid, grandkid, every year. Now, typically one of the holdups is the cost and overhead to set up and manage these. Usually with a traditional law firm, it'll cost somewhere between $5,000 to $15,000 to set this up. And then you're paying a trust company, $5,000 to $10,000 per year to manage these, which can really take away a lot of the upside. Part of the premise of Valor is we can help you set up these trusts at no cost, and our administration fees are fairly low, $1,000 per year. So it makes it, you can set up same day. So it's fast, you're not paying fees that take away from the upside of these accounts, and just make it more accessible. And so really you can get as much value out of this as possible. Now, going to some of these questions, this is probably an easy one here, is what's the tax rate on that someone pays on the, again, going to the scenario of there's $1 million in the Crummey trust, it generates, let's say, $100,000 of income. Yeah. Is the marginal tax rate their kids' tax rate, assuming their kids make less than they do, or the parents?
Yeah, so that's a good question. So typically the way these are set up is as grantor trusts. Setting up as a grantor trust allows you to pay the trust taxes, which is, like we're saying, extremely valuable. But it means that the trust is disregarded for income tax purposes. And so it's like a single member LLC. So the parents are paying the taxes at the parents' rates. And so it's not the kid's rate, it's the donor's rate.
Yeah. And just it's kind of got a good call out of, in the last kind of, addressing the last question, we were talking about, so essentially they're going to pay their parents' marginal tax rate is the easy answer here.